Hey everybody, this is Karl Eggerss, and this is our market update for December. It's our second one in December, as a matter of fact, and we're doing it to get it out before the holidays and given some of the recent market volatility. And what we're going to do today is we're going to go through a few things. We're going to show you kind of what's causing some of that volatility, how we got here, and then I'm going to illustrate a couple of other times in the last 20 years that are real similar to this as far as what we've seen with some of the volatility and what the stock market did during that time. So without further ado, let's go ahead and get started. The first picture you'll see here is the Federal Reserve, the Fed funds rate. Everybody has been talking about the Fed. What's the Fed going to do? And it's really important because what they do can either help speed up the economy or slow it down. And if you see the picture here, in 2008, they lowered rates all the way to practically zero and left them there from 2009 all the way until the end of 2015, and they gradually started raising them. Well, what did this do? Well, it caused a lot of people to borrow a lot of money and therefore speed up the economy, and that's what they wanted. So the reason this is important is because when interest rates go up like this, it affects your car loans, your all types of short-term loans, everything except a mortgage, but anything that's a short-term loan, 2 years, 3 years, 5 years, that's going to be affected by the Fed raising rates. And when they raise rates, it makes CDs and money markets start paying a little bit of interest, which is a good thing, but it competes with stocks. So now people have an alternative, whereas they didn't from 2009 until, really 2016. And of course, you have people, not us and probably not you, borrowing money to buy stocks. So when money's cheap, they go and actually borrow money and use that to go buy stocks. So the fact that the Fed's raising rates is undoing some of that. And you have real estate developers who may have to pay a little more. So rising rates generally signals a good economy, but there's a tipping point sometimes. And I don't think we're there yet, but certainly as we illustrated last market update, and you can watch our one from earlier in December, we showed you that the economy has been slowing a little bit. And it's not, we still don't believe there's a recession in sight, but it has been slowing a bit. And what we've been talking about on our podcast and on this market update is that when the Fed's raising rates, they're tapping on the brakes. They want to slow the economy to prevent inflation, a lot of inflation. That's their goal. But when they do that at the same time the economy's slowing down, that's when the market doesn't like that. And so we think they will probably stop or at least pause and let everything digest, and the market should respond favorably to that. But right now, they haven't had that signal yet. They don't have the all clear that, yes, the Fed's definitely going to pause. And in fact, we saw some of that, right, this past week with the Fed Chair Powell essentially saying we raised rates and we're going to see what things look like going forward. Now, what he's saying is we're going to be data dependent. We're going to take the data, and if it's good, we will keep raising rates. If it's not, we'll hold off. But the market wanted more than that. They wanted him to explicitly say we're done. Now, what's interesting is the Fed's already kind of changed their tune a little bit, because even just a couple of days after Jerome Powell came out, a couple of other Fed presidents kind of made the rounds talking on radio and television interviews saying, you know what? We do pay attention to what's going on in the markets. We pay attention to all these other factors, and just because we're data dependent, we're not necessarily going to raise rates inevitably. And we'll see, and we'll see if the market likes those types of comments. Now, as we move forward to what the market has been like this year, this is the Dow Jones average for this year, and nothing real fancy on this chart other than the fact that you can see we've had a little volatility, and especially in the last few days. And if you can see on the right, as soon as we kind of broke some of these levels, down we went. And sometimes the reason that is because there's algorithms set up, there's computers set up that say, hey, if it breaks this level, it sells. And sometimes that's a knee-jerk reaction, and that's a great buying opportunity. And many computers are just programmed that way. But here's the thing. Our minds, the reason these charts are scary sometimes is because our minds see this picture and we extrapolate. It looks like it's going to continue to fall and continue to fall and continue to fall. And, and many of you are in the South Texas area. Some of you, of course, are not. Well, in the South Texas area, we received record rainfall in September. Many places got 20, 25, 30 inches of rain during a couple of months there. Well, the places that got 20 inches of rain, do you think any meteorologist or you or me would say, you know what, we got 20 inches in a month? Well, does that mean we're going to get 240 inches of rain over a year? Of course we wouldn't say that. We know that there are times it's going to rain, there's times it's going to be dry, there's times it may even snow. And so none of us would say we're going to get 240 inches of rain and extrapolate that, except maybe Noah, right? But other than that, we don't extrapolate like that. But when it comes to the stock market and seeing it fall and watching our accounts and our money, our mind wants to extrapolate, and we will assume it's going to continue to fall forever. That's what we assume. We don't want to do that. That's just human reaction. But it's not going to rain forever, and stocks don't fall forever. But they do correct, okay? They do correct. They fall sometimes, they adjust, and eventually they rise again. Because at the end of the day, the stock market goes up because corporate profits in this country go up. Businesses are worth more, and that's what you're buying when you buy stocks. Okay, now we're only talking about stocks. Many of you have all types of investments, and really we'll talk about asset allocation in a little bit, but that's a very important part of this. But so we are talking about the stock market right now primarily. Now, one of the things about this stock market is everybody said this stock market is very expensive. And I won't bore you with necessarily what a PE ratio is, but essentially it tells you how expensive or cheap the market is. It's one metric. And everybody said, boy, the stock market's so expensive. And all they simply do is take the price and put it on top of the earnings or the profits. Well, it got up to 24, which is high earlier this year. Well, now it's under 17. It's kind of getting back into what a long-term normal range is. And the reason why is because the profits of companies hasn't gone down. Those may continue to go up. Only thing that has changed is the price of the stocks. You see, so people are changing the price of stocks, but the corporate profits are still the same. So the market has literally gotten much, much cheaper over that time. Maybe even 20, 25% cheaper over that time. And so that's a really positive thing for even people that were bearish on the market and saying, boy, stocks are so expensive. Now they are starting to get more in a normal range. Now, I've been doing this. I came into business in 1995, and it was an interesting time to start in the business because we started out in a tech bubble, if you recall, 1995, and we had this huge internet bubble, and then we had one horrible bear market in the dot-com bubble, and then we had a horrible financial crisis, right? And both of those, the markets went down like 50%. But before that even happened, I'll take you back to 1998 because we were in the middle of a bull market. Everything was great. The internet was just coming into its own. Stocks were going up. And smack dab in the middle of one of the biggest bull markets in history, that summer, Russia defaulted on their debt. So you invested in Russian bonds, which you probably haven't, but picture American bonds. Imagine if the U.S. said, we can't pay the interest. We're not going to be able to pay you back. And they defaulted. I mean, it felt like the world was ending. I remember this. I was only 3 years into the business, and the markets were freaking out. Russia defaulted on their debt. Long-term capital, which was a hedge fund out of Connecticut that used all kinds of leverage, so it was a very risky type of fund, they collapsed. Well, the Fed was worried that, and the world was, that it could bring down the whole financial system. And unfortunately, or fortunately, however you look at it, the Federal Reserve came in and bailed them out with a $3.6 billion bailout. But during that time, you can see here the Dow Jones fell 21% in literally 2 months. And then it eventually got it all back just, by the end of the year. So very swift, scary, sharp correction, no fun, stocks going down, pretty much every day. And it was a scary time. I remember that very well. Another time, and a more recent time, let's look at 2011. 2011, we were just coming off the financial crisis. People were a little skittish, not really embracing the stock market yet. A lot of things going on. But the market was rising, all through the spring, April, May, and June. Well, lo and behold, the good old US of A lost its coveted AAA rating on its bonds. We always had the best bonds you could buy. They're rated. And we had a AAA rating, the best bonds, pristine. Well, we lost that. And the panic set in. What's going to happen? all these foreign governments that own our bonds, are they going to stop buying them? Are interest rates going to go to the moon? What is going to happen? The stock market fell. The Dow Jones fell 18%. The S&P 500 fell 20%. It lasted literally from July all the way into October, about 3 or 4 months. And then eventually it turned around and started working its way higher. But that came out of nowhere. So that was a bull market correction. Now here's the thing. Everybody says, well, bear market's 20%. We don't buy into that. We feel like a bear market's more about how long does it last? Is it kind of a perennial downdraft? And these are short, violent corrections that are scary, but they eventually are bought. And that's what we had here. So this time, dead fall, over 20% from top to bottom. Even a little sooner, 2015, late 2015, early 2016, Brexit was on the forefront. We had a mini flash crash, they call it. There was some bad stuff going on. Again, market fell 15, 16, 17% during that time. Rallied, as you can see, fell again. Oh no, here we go again. Only to eventually rally, and then up we went. Again, in the middle of a bull market. And by the way, we saw oil during this time get down to $26 per barrel. So, again, people were worried about a recession. We had a slowdown. It may have even been a mini recession during that time. But it was not enough to have a bear market, which is a long-term, perennial type of downdraft. And let's face it, I mean, this picture here, this is what we're buying. Now, this is the Dow Jones from 1896 until now. And you have to squint your eyes to see what we're going through right now because it's so small in terms of the big picture. Now, granted, we're not all investing for 100 years here, but we are investing for 10, 15, 20, 30, some of you 40 years. And over time, again, as I said earlier, corporate profits are going to rise, and that's what leads to the stock market rising. It's not just air. It doesn't just go up and down because, people say so. There's real businesses that are worth more at the end of the day, and over the long term, that's the case. Now, there are times, of course, that we have volatility, we have recessions, we have wars, we have all kinds of reasons why the market will go down. The big ones on here that you can kind of see, the Great Depression right here, that's a big one. That was a 90% drop during the Great Depression. We're not in the Great Depression right now. We also had two big ones here just in your recent memory. The dot-com bubble, stock market fell about 50%. The 2008 financial crisis, market fell about 50%. But look at where we are now. So the point is number one, this is only stocks. Okay, most of you don't have all stocks. But number two is that even if you did and you rode through this, it's still higher. It's not fun, but it's still higher. And the reason I show you long term is because this picture here is a great illustration from out of JP Morgan. And what it shows you is the kind of the gross green color here is stocks. The blue is bonds, and then the gray is kind of a 50-50 stock and bond portfolio. And if you notice, this is 1 year, 5 year, 10 year, and 20 year rolling averages. The point of this is that in any given year, stocks and bonds and even a blended portfolio are going to be extremely volatile in any given year, up or down. So these years, what this is telling you is the stock market had a 39% down year at some point between 1950 and 2017. It also had an up 47% year. Okay, so you get a lot of volatility. As you move out 5 years, notice what happens. Very little volatility, and the returns are a little more certain. So you'll notice it says that stocks, the worst 5-year period from 1950 to 2017, the worst 5-year period was losing 3% per year for stocks. But the best 5-year period, it made 28% per year for 5 years. That was the best period. And what's even more interesting is look at a blended portfolio. It's never had a down 5-year period during that time if you own some stocks and some bonds. You go out 10 years, same kind of thing. You go out 20 years, it's even better. So the point is, this is where asset allocation comes in. So when you see on the news the stock market's doing this, that is the case. However, again, if you own stocks, and you own a lot of them, it's because you have more than 10, 15 years, 20 years to go through some of these bumps. And if you don't have all stocks, it's because you may need some money sooner. You're living off of the portfolio. And in that case, you don't have all stocks. You may have bonds. You may have alternative investments, all types of things outside of the stock market. So asset allocation is really, really important. It's probably the most important thing. How much stocks versus other things should you have? And that's something that we help our clients with, obviously, every day, getting that right. But the stock portion, if it's in there, it is meant for long term, and you're going to have big bumps along the road. But I think some of us suffer from recency bias, which essentially means we look back at things that happened recently and we say, well, that surely it's going to keep happening again. We've all lived through two of the worst bear markets in history. They happened literally this turn of the century, right? 2000 through 2002 or 3, we had a 50% drop. 2007 and 8, we had a 50% drop. Those are extremely rare, but they're in our mind. They're etched in our mind that that is what can happen. And so we go back and think, well, it's going to happen again. But it is out of the ordinary. Can it happen? Absolutely it can. But with proper diversification, owning non-correlated assets, selling some things at times, buying some other things that are cheap, owning some bonds, owning some alternatives. Again, everybody's situation's different. But through proper asset allocation, that can be improved quite a bit. But not only that, again, long-term is how we need to think. And if you say, well, I'm retired and I don't have a tremendous amount of time, well, you probably don't have all stocks either, and you have other things that you can pull from for income to leave your stocks for longer term. And those stocks may be left to a charity or the next generation. So asset allocation is really, really important. But this picture, and the reason I'm leaving up so long is I want you to look at it. It illustrates how the longer you go out over time, the more certainty some of your returns are. And I'll leave you with this picture. This is a picture from 1986 all the way until present, September of this year. Now, many of you were around during the 1987 crash. That was when the stock market fell 22% in one day. And it's circled right there. You can see it, 1987. Of course, it looks like a blip on the map now. Didn't at the time. But at that time, after that happened, a year later, there was a story that came out about a gentleman, and his quote was, "Wild horses couldn't drag me back into stocks. And rather than gamble in this market, I might as well go to Las Vegas." Curtis Bozeman said, owner of a sports medicine clinic in Mount Kisco, New York. And he's not talking theory. During the past several years, he had sold $300,000 worth of stock, 80% of his holdings. And he was far from alone. 11 months after that crash, most investors avoided stocks. So as it was falling and after it fell, remember it had already fallen, people started to get out. Wrong thing to do. Look at this. And by the way, we've circled the dot-com fall and we've circled the financial crisis. On September 30th, Mr. Boozman's $300,000, had he left it alone, just in the Standard & Poor's 500, nothing else, would be worth over $5 million. That is the power of time and compounding. Now look, this is not a 100-year chart. This is a chart that's only about 30 years old, right? From 1987, 86 until now. It's not that old. So for you putting into 401ks, you want to take advantage of drops. You want to continue to put money and plow money in there and buy. For those of you that are on the other end of the spectrum and pulling off your accounts and retired, you should still have some stocks for long-term for inflation protection. That part's going to be a little volatile at times. But there's also the non-stock side, the income side. And so again, what that ratio is in that portion depends on your cash flows and all those things. And that's what we do for clients to make sure that their allocation is set up properly so they aren't selling at the wrong time. But this gentleman didn't need the $300,000. The moral of the story is he let his emotions get the best of him, and he sold pretty much at the bottom. And that's what we try to avoid. You want to sell when everybody can't get enough stocks, and you want to be buying when there's blood in the streets, as Warren Buffett says. And we've had a garden variety correction. It's not fun, but this historically is a pretty normal correction we've been going through really since October. And this is the time to look for bargains because, again, for people that are saying I'm risk averse, Well, the market sold off some now. So some of the risk has been taken out of the market. So again, you got to focus on long term, but also focus on the asset allocation. If you have any questions, let us know. And by the way, don't forget to go to, we have a YouTube channel if you want to get more information, some videos there. And of course, we do our podcast every Saturday morning just to give you more insight on what we're thinking, what's going on with the markets in a little more of a timely fashion. So we appreciate it. Have a great Christmas and a Happy New Year. And thank you very much. If you need anything, we're always here.